developments so far in 2025 have raised a number of questions for fixed income investors. And joining me today to delve into these questions is Head of Fixed Income, Ané Craig.
Hi, Audrey.
So Ané, 2024 was a great year for South African bond investors, but 2025 got off to a little bit of a bumpy start. So the question many investors are asking themselves at this point is it safer to be in cash?
It's a very valid question. So I think this is an environment where low risk and highly liquid investments make a lot of sense. Cash rates, in particular in South Africa, have been quite high since 2023, especially in terms of the rate above inflation, or that real cash rate. But it's actually exactly that reason that means that our Monetary Policy Committee, through the SARB, is now under a bit of pressure to cut, which means, if the policy rate is lower, cash rates are going to become less attractive pretty shortly. So the market is looking at least 2 interest rate cuts of 25 basis points each this year. That doesn't leave us with a lot of meetings left. So yeah, the market is considering a pretty imminent reduction in cash rates, which means it should be less attractive than it's been in the past. And that's really because we've had inflation so low, which has been a triumph of monetary policy. But inflation rates now printing below 3% means that despite the global uncertainty, the SARB is going to be under increasing pressure if they do not cut the interest rate.
So with cash rates potentially coming down, does it then still make sense for investors to opt for South African bonds, for example, or should they be seeking returns elsewhere?
So for different investors, the level of exposure to bonds and to fixed income will obviously depend on what their goals are, but we think that there's absolutely still attractive returns to be made in the South African bond space and the South African fixed income space in particular, but it does come with a bit of caution. So yields in South Africa have been high. We always talk about real yields, so the yields above inflation. It's very important from a return, not just for fixed income investors, but what clients actually can do with their money as you want to continually beat inflation. So real rates have been really high in South Africa for a number of years, and that has led to bonds being a particularly attractive investment. However, they are high for a reason. So high yields are a reflection of the risk inherent to lending money to not just the South African government, but other South African entities as well. And so what's very interesting is South Africa has the steepest yield curve in the entire world. What that means is that very long-term bonds like we've got a 2053 bond as an example, but if you go to bonds that are redeemed sort of beyond 12 years out from today, they are pricing at much higher yields versus very short-term and what we call belly bonds, which is kind of in that middle, as a belly would be, of the yield curve. So our yield curve is incredibly steep compared to the rest of the world, and we at PSG Asset Management have been very optimistic about that steepness really compressing, which means yields go down, prices go up. And we've been very constructive, especially on a relative basis to others in the industry, on local bonds from around 2018 at least. So it's been a number of years. And we still think we've got all the ingredients to really lift structural growth in South Africa. And like we keep saying, the base is so low, so any kind of incremental improvements really do come into a very positive pricing effect and pricing loop. However, we have become a lot more cautious in terms of the pace of reform, and we can see this, post the formation of the coalition government, the Government of National Unity. Coalitions are new to us, as can be expected. Reform is slow. It's slower certainly than we were hoping for, particularly around logistics reform and Transnet. That really is going to be a key driver to get our structural growth high. So what's the yield curve telling you? It's telling you that South Africa has a fiscal risk problem. And really, it's a reflection, our real yields are a reflection of South African specific risk more than global factors. So we like bonds. We like them. We're slightly less convicted on them than we were in the past. And we don't think that you have to be exposed to the highest point of fiscal risk. So we spoke about cash rates coming down shortly. So that's not great for the return you're going to get on cash, but it's actually really good for short-term bonds as cash rates brings down that front end to the yield curve, and then you get nice capital returns on your income as well. So in summary, SA bonds is still a really good place to earn really attractive yields. Those yields are there for a reason, and you need a credible investor with a good track record of managing investments on that curve to know where to take interest rate risk and where to take exposure. And our exposure has gone from slightly longer on the curve to slightly shorter.
And recently we've seen some comments come out that led to some speculation that there might be a shift in South Africa's inflation targeting framework. Now, would this have any impact on your views, or do you think it will be much of a muchness for us?
So a different inflation targeting framework definitely will have an influence on views. You're referring to Deputy Finance Minister David Masondo, who spoke at a conference recently and made the comments that Treasury is looking at a new inflation framework. Now, it's definitely not much of a muchness, but it's not new news. So you have the governor of the South African Reserve Bank, Governor Khanyago, has stated for a very long time that he would prefer a point inflation target, and we know that the MPC has been targeting 4.5% and not the 3 to 6% band, which is legislative. But he has a desire for the official target to be lowered to the bottom end of that target range or closer to a 3% point target. Now, this has been consistent, and for at least 2 years, the governor has been quite vocal about it. We haven't really heard much from Treasury other than they're looking at it. So for Deputy Minister Masondo to say that they are considering a new inflation framework, it could mean a couple of things, but it probably means that they are in the research phase of considering either a lower and tighter target band or a lower point target. I say lower than 6%, whether it's 4.5, whether it's 3 to 4.5, 3 to 4, we don't know. Long term, this is really positive for bonds because, as you know, high inflation breeds higher inflation because of how people set prices. So we always call it about administered prices, but it's particularly powerful in wages. Now, if we have belief that the Reserve Bank is going to keep inflation below 4.5%, that means that wage negotiations for increases above 4.5% become less and less. So when investing in any instrument that is long-term in nature, if we have a lower inflation target, it means that investors can price in lower inflation risk. So this is really good for assets like bonds, longer term. Shorter term, it depends how they get there because there's obviously a cost to the economy. So if you have high policy rates, high real rates, that constricts the economy. It doesn't provide lending and lending-led growth into the economy. So I suspect what Deputy Minister Masondo was referring to probably included a view on how to lower the target if they actually agreed with the Reserve Bank's research to do so. So we'll see how it plays out.
So getting back for a moment to talking about where fixed income investors should be looking and what they should be doing, can you give us an idea of how investors would go about accessing the lower risk inflation beating returns that we believe is potentially still on the table?
Yes, so there's a number of products out there, and I can certainly only speak to where we as the PSG Asset Management see value. So we have funds in that short-term interest-bearing category and that multi-asset income category. And particularly in short-term interest-bearing, we have a fund, the PSG Income Fund, that has a long-term track record of beating cash, beating inflation at very low levels of risk. Now that we think can provide a really, can play a really powerful role in an investor portfolio now where volatility globally and uncertainty globally is really high, but cash rates are becoming less attractive. So it gives you cash plus return, but not at much extra risk. And it is still a really highly liquid investment. And how we are able to generate those returns is obviously the scale of unit trust, and that kind of pooling of funds means we can get the best rates from counterparties that we invest with and lend money to. But we also are able to offer diversification. So we speak a lot about South African government bonds, but there's a myriad of fixed income instruments that range in complexity as well. That we invest in. So it's a very diversified portfolio with a lot of different drivers of return to be able to also lower the overall risk profile. So very liquid, very low risk, track record of beating cash and beating inflation, and we think that could play a really nice role in the world that is 2025.
So Ané, we're almost out of time, but just before we conclude, can you give our viewers an idea of the objective of the PSG Income Fund, as well as who it may be suited for?
Sure. So it's definitely a low-risk fund, and it's suited to low-risk investors, and we look at an investment horizon of at least a year. Investors can use it in several strategies, but it definitely fits in that income bucket. So as we were discussing, lower risk, but also lower return. And the goal of that fund is to beat inflation and to beat cash. It's got a cash, a Steffi benchmark. So it really is for investors invested for, we'd say, at least a year, looking for cash plus returns at low levels of risk.
Ané, thank you so much for joining me today. It was great talking to you.
Thanks, Audrey.